So the market was down on Friday. And the question is why? And the answer to that question is very, very simple. We got a jobs report that came out on Friday, and it showed that we only added 22,000 jobs, and we were expecting 75, which most of you know how I feel about analysts' expectations. They're worthless. In addition to that, unemployment came in at 4.3, up from 4.2, which was as expected. Now, what this does is it feeds the narrative that the economy is in worse shape than anticipated, and we're trying to get interest rates to come down to spur on the economy. But like I say, last year when we did this, the bond market didn't agree and thought that the economy was too hot, and by lowering interest rates, it would heat up. This year, it seems to be going the opposite direction, which, as I've told you, is the most important part of this, because as we try to lower interest rates, if we lower the Fed funds rate like last year and long-term rates go up, that's going to hurt us. So this time, it seems to be the opposite. Yesterday, bond rates actually got under 4% for a little bit, which is fabulous. If you look at the 6-month time frame, it's actually going in the right direction, as you can see on the screen. The problem is on the 1 year, we're still not where we were a year ago on the 10-year Treasury yet. This spurred on the biggest one-day drop in over a year in mortgage rates, which is what we really need to see. And even though the market was down for the day, the S&P was only down 0.32% and well off the lows of the day. So what you need to understand from all of this is that maybe on a short-term basis, we're going to see some volatility as we work through the fact that the economy is not as strong as they've been telling us. And when we start lowering interest rates, there's going to be some volatility in the fact that the bond market's got to respond to it, the stock market's got to respond to it, and a lot of the decreases in interest rates have already built into the stock market, and that's okay. The key is to just not freak out about it. Whether this volatility lasts a month, 2 months, 4 months, 6 months, it really doesn't matter unless the complete underlying economy goes to the toilet, which I don't see at this point. I mean, 4.3 unemployment is still not horrible. Even if it goes up to 4.5, still not horrible. Even if we have a couple of months where we have negative job growth, again, not horrible long term. The key is, does it continue and is sustainable? So we may run through this. There may be some more volatility down the road. It's okay. It's expected. We have to go through the growing pains to get where we need to go. We've got to get these interest rates down. Dickie out.